Welcome to MHN Voices, our series through which we present insightful discussions among industry thought leaders, moderated by our editorial team. Today, we'll provide an outlook and answer your questions about the growing single-family rental sector. I'm Suzanne Silberman, Editorial Director of Multi-Housing News, and I'm here today with four industry leaders. James Ray, Portfolio Manager for MetLife Investment Management, Mark Wolf, Founder and CEO of AHV Communities, Mitch Rotta, Senior Managing Director and Head of Build for Rent for TruAmerica, and Paul Fiorilla, Director of Research for Yardi Matrix. We're recording this session and it will be available for later viewing. In addition, we're going to leave some time at the end to answer your questions, but please feel free to submit them at any time during the webinar. And thank you to those of you who submitted some in advance. We'll try to get to as many as possible. To kick off today's webinar, Paul Fiorilla is going to provide a snapshot of U.S. SFR BTR performance. Then we'll jump into an in-depth discussion among all of our panelists, providing perspective from investors and developers. So Paul, I'll hand things over to you.
Thanks, Sue. It's great to be here. And good afternoon or morning to everybody, no matter where you might be. So Yardi Matrix, the data, I have a presentation with some data. The data comes from Yardi's database of single-family rent, build-to-rent communities, which encompass communities of 50 or more units. Our database has 158,000 completed units and almost as many that are in the construction pipeline, totaling about 300,000 units and about 64,000 units under construction currently. So if you could move to the next slide. So there's been a lot of similarity in terms of performance between single-family rental and multifamily. And you can see with the big bump in the 2021, right, coming out of the pandemic, there was a huge amount of demand for housing of all types. Household formation rose to more than 2 million in the year 2021, driven by strong rebound in job growth as the economy recovered from the pandemic lockdowns. We added a lot of jobs, wages went up at above trend levels. There was a lot of excess savings from stimulus checks and a desire for families to have more space. And that encompassed a move to the suburbs, move to Sun Belt, move to smaller metros. And that's very favorable to single family rentals because, people want, people who want more space for their children or pets or, to work from home. That moves people in a lot of cases, out of small city apartments to single family homes, either in the same metro or to a different metro where prices are less expensive. And people, largely want the people who are moving in that case largely want the amenities of single family homes, but either, they want flexibility to rent instead of own a home, or they can't afford the down payment to buy a home, or some other reason their credit's not good enough. And of course, right now, as we know, with mortgage rates being what they are, the cost of owning a home is significantly more expensive than renting a home. So for all those reasons and more, single family occupancy growth has been very strong over the last few years. Took a slight dip, but it is 95. So the occupancy rate nationally of single family rentals right now is 95.9%, and that includes 97.9% for renter by necessities, which I guess you would kind of the equivalent of B and C properties, less expensive properties. Higher end properties have a 95.5% occupancy rate. And all of those numbers are extremely strong. So the demand for SFRs is very robust at the moment. So if we can move to the slide about rent growth. Again, rent growth for SFRs have in large part followed the same trend as multifamily. There was about 14%, the peak rent growth about 14% year over year in the middle of 22. It has since decelerated to about 1% overall, but still the overall SFR rent is $2,117 according to our database, which is significantly higher than it was just a couple of years ago. So the performance of SFR properties has been very strong. Now, a couple of things I would note about this chart. One would be that, as you can see, that the higher end properties, which did very well during the pandemic, have now trailed the kind of middle income properties, and that's a sign that one of the main reasons that rent growth is going down is just declining affordability. When rents go up 15-20%, it's kind of strains the ability of renters to afford higher end units. So there's more demand at the moment for renter by necessity units. Another thing I would say would be that the strong demand that we saw in 2022, 21, and 22 from migration, the migration from the big coastal markets has kind of slowed down as well. So demand has decelerated, but it's still overall extremely strong. Go to the next slide. And during the 2021 and 22, mortgage rates were really low. Investors were looking for higher yields than they could get from multifamily. That caused a lot of investors to put money in SFR funds and companies. And there were a lot of transactions which have declined this year, about 60%. Now, this chart, you can see it peaked at about $2.8 billion of transactions in 21, 2.7 in 22, and we're just a little bit more than $1 billion for this year. Now, these are not scattered. Now, when I'm talking about growth of SFR companies, a lot of it has to do with scattered site sales where the companies buy the properties one at a time. These are the sales of communities of 50 or more units. So it's not exactly the same thing, but I think the trend is the same for the acquisition of communities versus the acquisition of scattered site. It's gone down tremendously as rates went up and the math doesn't pencil, and there's less investment dollars coming into the sector. Next slide. So the growth of SFR is increasingly going to be coming from build to rent, which the developers build their own properties as opposed to buying them. So this is the pipeline of the deliveries in communities with 50 or more units. You can see, again, it peaked in 2022. We had the highest number ever, 15,000. And this year we're expecting about 29,000. Next year, about 28,000. And as we go forward, we're expecting strong deliveries. Currently there are 63,000 SFR properties under construction, which is the highest number ever. And a lot of the growth, as I said, it comes from building, and a lot of SFR developers are looking for sites that are owned by single-family developers, and the single-family developers can't build for one reason or another, either because of the cost of construction financing or some other reason. And so acquiring those kind of sites is a focus of some SFR developers and funds. So the regional development, most of it is in the Southwest, the Southeast, and the Midwest. You can see some of the metros that have a significant amount of stock under construction: Huntsville, Alabama, Savannah, Orlando, Jacksonville, Southwest Florida coast. So those are some of the regions where we see the most development among SFR companies. So going forward, we're going to see a focus on not only on the development pipeline and growth through BTRs, but also a focus on operational efficiency, cutting expenses, and finding development opportunities. So anyway, that's I'll leave it there and we can get to the Q&A. Thanks.
All right, well, thank you so much for setting the stage, Paul. Let's begin our discussion by getting some opinions from the rest of you about the long-term prospects for single-family rental as an investor sector. And Mark, can you start us off?
Sure. Thanks for having me. Pleasure to be here today. I hope everyone's having a good day. Yeah, my outlook on the space is extremely bullish. When I started this 10 plus years ago, I saw a lot of similar fundamentals today going forward. Wasn't directly correlated to a great financial crisis like we had in 2008, but we certainly have an interest rate crisis and a housing crisis that still persists today. So I think fundamentally, the space is poised for some significant long-term benefits. I think we still have some rocky road ahead of us. You have an apartment sector that's going to deliver an ungodly amount of units to the market, which is going to impact everybody to a degree. We're already starting to see it a little bit in occupancy and absorption. At some point, people just have a price that they can afford. So I think that whether they want to be in a house that has amenities management and maintenance that costs X, if an apartment's available for some significant less price, they're probably gonna make that decision to go there, and everyone's going to be racing to try to fill units in the next kind of 12 months plus or minus. But I think you go out 2 years, 5 years, 7 years, extremely excited about the future. I think that the adjustment in the market in the last year and a half, getting rid of a lot of people that probably rushed into the market at the end of the last cycle, some people that didn't have anything more than a business plan in one of the best sectors of real estate are gone. Those guys did not survive. They won't survive if they're still hanging around. And you're going to be left with a normalized playing field going forward with people that are really interested in building long-term businesses, not trades. And we should have what I consider to be a mature market going forward for build for rent, but extremely bullish despite today's tempered excitement, because it's not easy today, which I'm sure we'll talk about more later. But I'm very, very bullish.
Mitch, James?
Yeah, I'd echo the same thing as Mark. I think it's as you've just seen this business mature, I think one of the key highlights too that we're starting to notice too is just the definition of what is built for rent. I think when we first started up, this sector had to gain an identity, and to gain that identity, we put a lot of different things into what we call build for rent. Different product types, different platting methods. It just really started to kind of become a hodgepodge of product type to gain some momentum. And I think that momentum is there. I think people understand it more. And so with that is going to start to become kind of the bifurcation of this asset class that will have very distinct product types that make it up. And for that, I think that'll push, this asset class into the future to really start saying, what is horizontal apartments? What does that actually live under? How does that actually trade? What is true build for rent communities, and the product type inside of that? How does that trade? How is that treated? And then kind of scattered site SFR and what makes that up in portfolios. So I think you'll really start to see these things kind of become their own identity now that the momentum is there. And I think at the end of the day, the capital is there and behind it. We're just in a moment in time right now where real estate in general is difficult.
And James, do you expect it to become a bigger asset class, like a major asset class, I guess I would say, with increased investor involvement?
Yeah, no question. So thanks again for having me. I really appreciate it. Nice to see you all. I would say that my answer to the last two questions is exactly the same, which is basically it all comes from a perspective of us being a housing investor first, right? So we invest in the housing space across the board, and primarily because what's most important to us is that there's demand on the ground, right? And so in a nutshell, there's a lot of uncertainty across a lot of different asset classes right now, across different capital market tranches. But what we're not uncertain about is there's a lot of demand for low density housing, right? And so from a rental standpoint, from an ownership standpoint, and then we're also not uncertain about there being demand from an investor's perspective in rental housing. It's a really good asset class for a number of reasons. It's a big asset class, and we view this as just part of that, right? So, are all the nuances that define SFR and build to rent critically important? Yeah, they are. But we are really focused on this from a housing market play and making sure that we're delivering the types of units that people want and that they're professionally managed and that we're giving investors what they want, which is a much larger allocation of this. So I think unquestionably this will be a much bigger piece of the housing pie going forward.
Yeah, Suzanne, if you take a consideration at the peak, the heyday, tracking something like 60 to 80 billion dollars of interest in this space. Now that was a lot of marketing headline, brouhaha. None of it was, a lot of it was just people wanting to be a part of something, but that's a pretty significant, kind of headline. And if half that makes it into the space, it's a real asset, a real subset of multifamily. So this is here to stay. It's been institutionalized. It's widely accepted, which is, I think, why the outlook is so bright. When I started this 10 years ago, it was really us and Next Metro doing it. No one else was doing this. They were doing the horizontal multis and we were doing the detached single family kind of, managed, maintained, amenitized. And to Mitch's point, it's taken a lot of forms over the years, but when you really look at the community-centric approach, it includes management, maintenance, and amenities, contiguous and cohesive community. That is institutionally accepted and desired today. And so I think that, all the training wheels are off this business now. Going forward, you're going to see massive growth because of that broad acceptance from institutional investors. Because as someone who raised money deal by deal, friends and family, high net worth folks, it was a very slow moving train. And now when, big firms get involved and they deploy billions of dollars into the space, it can grow a lot faster.
So institutional investment has been growing, but it still constitutes a very small percentage of single family homes. And I know that that's been a big point, that there's a lot of room for growth and still plenty of room for the traditional home ownership and home sales by owners. However, the New York Times recently reported very large percentages in some cities. They focused on Charlotte as a city where there was a huge percentage. And there have recently been bills introduced in both houses of Congress to limit institutional ownership. So clearly there's some concern out there from the private side. So let's delve just a little bit deeper into this. Mitch, I wanted to ask you first. With the greater shift to build to rent, how much existing property and on a relative basis are institutional investors buying? And how do you see the interest, and Paul, I think you referenced this a little bit during your slides, between the scattered site and the new build to rents? Is the focus shifting really heavily now toward build to rent?
Yeah, so I'll take it in kind of two parts. First is, how much product does this make up, right? So like on average in a booming type environment, a delivery of single family homes, for sale product will deliver about 1 million homes on a yearly basis. So I think Paul just showed that, we peaked on the most deliveries of build for rent at 67,000 units. So we're making up like under 7% of all housing stock that's coming in. So we're a drop in the bucket. I mean, you litter that across the top 50 markets and, it's nothing, right? It's really not moving the needle at all. It just has a lot of attention. And I think that attention has been around because it's, been a growing sector for some time. And I'll kind of answer the second question now, which is like, what is the strategy? And over the last couple of years, I think you saw a lot of money go into build to rent because it had a lot more operational efficiency. And it felt a lot more familiar to big institutional capital versus maybe more of the mom and pop, friends and family, high net worth type of investors. Institutional understands contiguous communities. They understand cap rates. They understand buying and selling of that and how to compare those things. So I think there was a lot of shift to that because it felt familiar. And then as home price appreciation just started getting, really out of hand and to the point where it just moved a lot of middle America out of the ability to buy, the SFR operators saw the same thing, right? Eventually you can't pay, X amount of dollars for a single asset and then try to put $40,000 to $50,000 into it of additional renovation work and then rent it out as something that's attractive to the capital world. So, you had this kind of conundrum right now that you have most of America who's, sub 5% on a mortgage rate. If they sell, if they don't, that's probably going to really what opens up that strategy. But you can already see a lot of the SFR operators that did scattered strategies going into build to rent, buying up the 50 unit to 75 unit type communities across the country. And there's a real appetite for that because they're seeing it operating efficiencies as well versus their original business plan. So I think you're kind of starting to see how this thing just morphs to being more build for rent centric because it's now got a real business plan behind it. It's got real intention behind it, and it's satisfying what people are looking for, or a portion of what people are looking for. But there's still a huge road to go in terms of like how much product we're providing to the space versus the total housing stock in America on a yearly basis.
Yeah, James probably has more of the data from the chair he sits in, but I think there's around 5% of, is institutionally owned of a market that's probably 15, 17 million homes that are rentals. So it's an infancy in terms of comparative like gestation of a business, right? It was a mom and pop business for 40 years. And in the last 10 years, we've seen some tepid interest with the three big firms, the Blackstone, American Homes 4 Rent, Pradium entering the space, comprising about 250,000 of those units, and then a handful of others, Tricon and a few others. But for the most part, it's still very much, an entrepreneurial business backed with a few major players. But even those folks are kind of starting to, AMH is less focused on SFR aggregation, more focused on built to rent. And it's a whole, we can go down that road later, which I'm sure you're going to bring up. Really what's driving this angst with home ownership and the Wall Street firms. I think you have a question on that later on, probably want to talk about rather than now. Okay. You referenced the political,
yeah,
bill. Yeah, we can save that, I guess, unless you want to talk about it now.
Sure,
go ahead. Go ahead.
Yeah, I mean, so yeah. I think it's a lot of political banter. It's the typical hang the carrot out there, talk about it and do nothing. I do think there's sincerity behind what they're saying, but I think that at the end of the day, the rub is that Wall Street controls everything, and if they want something, they're going to go get it. They're going to take it. So if they want this asset class, they're going to go create it. They're going to grab all the product that's available. They can outpay you. They can outmove you. They can move quicker. They have more money than you. So they could actually take and do what they want, i.e. Charlotte and Atlanta. These certain areas have been overwhelmed by investors or Wall Street purchasing. And I'm a capitalist, so I think that's okay. But it's unfortunate. And I think the rub is that it's the Lennars and the Hortons and the Pulte's of the world that are selling these houses in bulk to people in a manner which that it was supposed to go to a homeowner. So Bobby and Susie can't compete with Wall Street. They have to go rent that house back from Wall Street. I think the big difference, well, I sleep better at night and why I can kind of look over there and say, I get the rub. I get why government's angry about this, because we're creating housing stock from scratch. We're not building a house that would ever be for sale. We are building it for rent. That's where I came up with the term build for rent. And we trademarked it because build for rent to us was exactly that. As explained to the city council members who wanted homeowners in their neighborhood, they wanted to have people set down roots and buy a house and be a taxpayer. And I said, well, my houses are never going to be for sale. They're always going to be built for rent. And that was a comment that I think resonates. And I think that when you look at the maturity of this industry as we move forward, we're creating a solution to a very large problem. We're contributing solutions. And Wall Street really isn't doing that right now from a direct purchase aspect, right? They're exacerbating a problem of affordability because no one can compete with them. And then if you have enough of a market share, you can set the rents. So it's just kind of an ugly, I get it, right? It'll work itself out, but certainly don't leave it to government.
The only thing I would add is that, obviously have no comments on specific policy or anything like that. But from our perspective, housing is a super complicated space and it's a really important space, right? It matters a lot. All of the sectors that we invest in matter a lot, but housing is really critical. My firm has a really long history, like 100 years of investing in housing with a bend at different points in the cycle toward the more affordable side of the market, right? Realizing that's a big problem. And I think we're all proud of that. I do think, I guess the biggest point I would make is it's so important. It's incredibly important when you're talking about the housing space to disaggregate what you're talking about, right? With respect to supply and demand. So as a perfect example, you can throw out an acronym, SFR. That means different things to different people. But it's really, there are two radically different strategies in that space, right? I mean, one is I'm going to build the skill to find, repurpose, and manage homes that were built for owners, and I'm going to offer those to renters. That's one skill set that people do. They've gotten really good at it, and they get paid well for doing that. And Mark, one small thing I would say, maybe a small amendment to what you were saying, is I do think the capital markets will. It's not such that Wall Street can necessarily outcompete, because we've seen interest rates go up a lot and they can be pushed to the sidelines just as fast as homeowners. But still, that's one apparatus, that's one model. The other model, which I think most of us are focused on, is build to rent, right? So we are not interested in taking any units out of the stock. We're not interested in frankly buying anything that is with respect to my fund. We're not interested in buying something that was built for an owner, and then when the capital markets move, we grab that and turn that into a rental. We could debate whether that's good or bad, but either way, it's just not a focus for where we're raising money and what we've invested in. And I think this gets, Mark, to your big point, which is, and it gets to what Mitch was talking about it being a drop in the bucket. There's such strong demand on the user side with respect to all kinds of financial perspectives. Whether you're affluent, you have a lot of income, you have no kids, you have several kids, there is so much demand for low density housing because we just haven't built that much of it, that on the purpose-built side, I view it as sort of a win-win. And that's why we're very focused on that. And so my biggest point there is just that I think it's really important to disaggregate the space, especially when you're talking about policies and societal impacts.
So, Paul, do you have a sense of how demand for single-family rentals is comparing to the demand for multifamily rentals? And obviously, I know there's a big shortage of housing across the board.
Right.
What are people, I don't know, gravitating one or the other?
There's a demand for all kind of housing, and I agree with pretty much what everybody on the panel here is saying about SFRs, that there's a lot of people that want the amenities of single family homes that don't necessarily want to own them or can't own them. So the demand for this particular product, I think, is going to stay extremely strong for the foreseeable future. If I would just, but when it comes to institutional growth in this sector, right, we're talking institutions. The Urban Institute did a study earlier this year and estimated that institutions that own 100 or more units own, I think, about 600,000 units, and there's 17 million single family rentals in this country. So I agree that the institutional side, it's got nowhere to go but up. I think easily within the next few years, you can see that portfolio double or triple. I would just say one thing, Mark said if Wall Street wants to buy something, they can buy it. And if that were true, then some of these bills that are in place that would limit, Wall Street's involvement, maybe they would make sense. But I don't really think they do, because we need more owners of housing. We need more creative solutions to provide housing for the country. We don't have enough of it. But there's limits to institutional ownership. Some of them have been mentioned. When the cost goes up, that's prohibitive. When interest rates go up, that's prohibitive for institutions. But also, we've seen from the beginning of this market, and this market started, after the global financial crisis, when some institutions, bought up portfolios of foreclosed home mortgages. Managing the management part of it is not simple. And, it's a niche sector. Not any institution could just go into the market and be successful at this, because it requires a certain expertise that's very specialized. So the number of players that can do this successfully, in my opinion, is still pretty low, right? There's a handful that are good at it, but not just anyone could do it. And the other thing is the size of the properties themselves is a limiting factor. So we're, each home is, a few hundred thousand, 200,000-300,000. Some of it's a little bit more. But if you're a big institution, looking to invest 10, $20 billion, you're constrained to invest in things that, are too small. So I think the growth of the institutions in this sector will happen, but I think it'll remain a niche sector for, at least the next 5-10 years.
And I think, and then what I'll say is that even at $20 billion, right, of an average home price of 350 grand, it's like 57,000 houses. So the asset itself is also very expensive relative to what we're used to in multifamily, where you could, buy these things at $80,000, $100,000, $125,000. So like the asset itself is just a more expensive unit at the end of the day that you got to look at. So it's not getting cheaper, right? If you look at the home builders right now, their average price point now, I think Pulte is just under $500,000 for a new house, right? And what's selling today is lots that were produced 2-3 years ago at way cheaper basis, and all that went up 15%. So the new housing stock that's going to come on in America is going to have another 10 to 15% increase on top of it from today over the next 18 to 24 months, and that's not going to get any better, unfortunately. So you have to create something that can appease to the marketplace that's getting eliminated because of just natural price increase that's happening. And when you have shortage and you can't produce enough of it, it's just going to keep going up. And it's just going to keep going up.
That's the natural.
That rate is going to be, something that you can't satisfy.
That's the limiting factor on Wall Street, right? To your point, and I don't disagree. At some point, they won't be able to act in the space because it wouldn't make financial sense to invest or otherwise. But that's a big point right there, Mitch. Everything's getting more expensive. And unless you create it from the ground up and extract as much of the cost out of the deal, you're not gonna be able to make this pencil. One of the unique things about AHV, we're 100% like integrated. So we basically like to find dirt that is zoned, not entitled, not mapped, not platted. It's not someone else's vision. And so we create the community from the ground up. We're truly built for rent. We build our own product. We execute the acquisition, design, development. We build the houses vertically integrated, and then we operate. We're extracting profit that would otherwise go elsewhere. And it's now getting more expensive to do every stage of this development process. And therefore, the home builders, they're no longer selling to a Wall Street at high velocity because they don't have a lot of velocity. They're going to sell at the highest, widest margin, and those margins, the prices are getting higher and higher. And therefore, it's harder to just pass on the rent to would-be renters, making it not pencil. And so if you're in the unfortunate position where you don't control your own destiny, i.e. you don't build your own product, you're now relying on someone else to build it for you. And at what margin are they going to charge you? Well, if the alternative is they can sell it to a very, very, very tight supply constrained environment, you're not going to be able to get it on the cheap. You're going to have to pay for that asset. So you're going to pass. It will go to the homeowner eventually, and then you're stuck without product. So there's a lot of people out there, I think, they're going to get caught up in this scenario because they don't control their destiny. They're relying on other people to build, and no one's going to go build it for cheap just so it makes your numbers work. So
yeah, I think that's a really good point. I mean, I would layer onto that just one quick thing, and then maybe a broader perspective. But to kind of put all of that in a nutshell, I think the bottom line is the average cost to build a unit, call it a lower density unit, $250,000 to $350,000, right? And so if that's the reality that we're all facing, even if you got the most aggressive investors, debt and equity, that's a $2,800 to $3,500 rent check. Is that affordable relative to the national median? Probably not. Is it affordable to the 70th percentile that's in a high demand suburb that wants access to some space and decent schools? It's super affordable, right? And so that's why I say you have to disaggregate it. But I do think that's a really important point. I don't think anything should be, I think we should be able to question everything, right? I think we should be able to bring it up. But the reality is that those costs are very, very real, right? And that's something that we don't talk enough about. The other reality that I would say is very real, Paul, back to your question about how big could the space be. In some ways, my personal take is I don't really care, because what I see is very, very strong demand on the rental side. And if you take another niche, as you were talking about, but take it on the capital side, I mean, core property funds are a relatively small percentage of our broader capital universe, but they have the lowest discount rates. They're $350 billion or so. They're probably 30 to 40% invested in office and retail. They don't want to be. They're going to come down. And the only way to come down is to go through data centers and build to rent. And so in my mind, what we're trying to do is build product with folks like AHV and others that are saying, listen, this is what feels good to you from an ownership standpoint and that renters really like. And regardless of if this space is 5% or 50%, there's a lot of demand, a lot of runway with core investors that need to move those allocations in our direction. At least that's my opinion.
And that investment horizon, by the way, for Mark is 3 to 5 years before those units come online, right? So like that's the other limiting piece of this is it just takes so long. So
It's so
money
easy
goes
too,
in and it
Mitch.
takes, it's years and years before you actually even see what this actually comes out to be.
And it's so easy, right? It's just so easy.
And
So
to the
Jake-
point about institutions, when you look at something like the NCREIF index, which is an index of the biggest core funds, they, a decade ago, they were, 50% office and, trophy office and large malls. And now, the percentage of those assets have dropped precipitously. And the percentage of niche product types has increased, exponentially over the last 10, 15 years, and probably will continue in that direction.
So James, you were just talking about the costs and the rents and so forth. What's the ROI potential of this sector?
So we may have a little bit different perspective on this than most. Obviously, we're trying to get suitable returns, right? But our general strategy is not to go out and do whatever it takes to get the very last penny. So said differently, if we could go 40 miles outside of a core urban location and find a decent piece of land and build something super dense to make it work on a pro forma because it gives us a higher IRR, or we do something that gives us a lower return, but it's in a much closer in an area where we have a lot more confidence in and we know the submarket a lot better, we're going to take that latter investment every single time, right? And so I would caution with just throwing out returns, and I suspect I'm not the only person on this call that has that take. We're surviving for a reason. I know that's the case with HV. In some cases, though, it doesn't make sense to go as urban as you can. It does make sense to go to the second rung. And so I think the bottom line is if you just look at the space in total, so commercial real estate, just to oversimplify, I think if you look at long-term holds, total returns range from kind of 7% if you want to do the safer stuff to 11 or 12 if you want to do the riskier things. And I think long run, because of a mix of factors, I could see build to rent, especially if you want to buy it and hold it, I could see you getting a little premium. So call it 100 basis points-ish. This is, again, just my perspective. If you want to do development, I think you'll get a couple 100 basis points premium for that. And the reason for that is we have some tailwinds here that you don't have in other sectors. And I got into this space and into housing as a generalist and got into housing and then got into single family from there. So I'm pretty familiar with some of those other sectors, and we don't have some of the things that I really don't like about those other sectors, namely, and there are opportunities to do well in those sectors, obviously, but namely around capital expenditures, right? So the rents are fairly predictable. No tenant makes up more than 0.5% of your rent roll, kind of a thing. You don't get blindsided with these massive capital bills. That puts a lot less volatility on our space, and it's housing, and there are multiple different uses for the land that we buy. So I think all of that say relatively positive things relative to other housing returns. It would be my rough take.
So we're rapidly running out of time. We need to switch to Q&A soon. We could easily do a part 2 of this. And I had a feeling with this group that would be the case. So maybe we will. But let's talk a little more about the build to rent segment of this specifically. And Mark, you were talking about some of the challenges of it previously. And I wanted to ask you what other challenges there are that people should be taking into consideration if they're looking to get into this segment.
Well, I mean, it depends on how you approach it. We're a holistic developer. We look at it from the ground up, and that takes time. It's not just an immediate, invest and get returns. And so that's a big hurdle to overcome. Capital is probably my single biggest challenge. And we're out there trying to solve for that now with some longer term permanent capital sources. And interestingly enough, are finding some interesting success thus far. We should have something big to announce, hopefully in the next 30 to 45 days. But the market's quite receptive to the long-term play that we're kind of, the way we approach it. Land, it's tough. Municipalities are tough to navigate. Cost construct, tough to navigate. Controlling your destiny, tough to navigate. There's layers upon layers of challenges that, at every step of the process you're faced with. And then there's the unknowns, right? Then there's market conditions that no one expected, a year and a half ago to be this crazy with interest rates. I was borrowing at 5%, I'm borrowing at 10.5% right now. The couple of the caps that we had have expired, and you're not going to spend $3 million to buy another cap. You're just gonna have to grin and bear it. Projects have taken a lot longer to develop because labor's, increasing. Labor is increasingly becoming more short, right? Like there's a shortage of labor and it's increasing every day. It's getting worse. No one's running into construction like, hey, I want to be a framer. Hey, I want to be a plumber. Unfortunately, everyone thought they had to be a doctor or a lawyer in the last 20 years. And now the labor pool is shrunk so small that it's hard to build. Technology isn't there to really offset that shortage to any degree. So it's just become harder. The mousetrap, they've been building houses for thousands of years, right? And call it a couple hundred, the modern day house has been built. The last 200, 250 years, the houses are, okay, fine. You go to England, you see a house similar to what you have today. Nothing's really changed significantly, just a lot less people doing it. So I think the single largest component is if you have the money and you have the land, you still got to build the house. And I think that's probably the biggest challenge of the day.
Okay, thanks. And what's the role, and James, maybe I'll ask you this, what's the role of home builders relative to this asset class? What's your strategy to compete with them or to work with them? Where do they, how do you fit into their markets that they've maybe been building in locally for many years?
Yeah, great question. I think, and it's very different than it is in the more urban environments where most of that product is rental. And the condo builders and sellers are the vast minority. Well, when you get outside that super urban core, it flips, right? So most of the players are owner oriented, to build to sell. And then you have others that are trying to do different things, which I think are generally good for the community. But it's harder for them, right? And they have to be much more candid and open. And so, because of that, I find that relationship to be really an interesting one. So I have a lot of admiration and respect for home builders. I'm sure that there are folks in my company that invest in home builders in a couple different ways. But what I would say is that they're generally not set up, just in the simplest sense, they're not set up to be owners, right? They are really set up for margin and moving. And they're really, really good at what they do. Whether you have the behemoths that focus on the middle America housing on the lower end of the price points, or you have some of the more, the smaller players that are really good at what they do and they build kind of quasi-custom or custom-like feeling houses. They're both really, really good at what they do, but they're both the same in the sense that their DNA is to build as fast as they possibly can and sell it, and not to get stuck with inventory of land or product. That is just so different. Like you heard Mark say how long it takes to get these things going. And so in my view, sort of the foundation response to what you were saying is that the DNA is so different. It doesn't mean that you can't make good partners. You can, but you need brains of the operation that are focused on what you're really trying to deliver, and not sort of sell out in the short run for a margin. And I don't blame home builders for being focused on that. That's their business. Nor do they blame us for being focused on what we're focused on, but that's our business. And so I think the answer is we all work together, but we've got to find ways to make those different DNAs fit. Our approach is bifurcated. First of all, we will work with home builders in a lot of instances, the same way that others will. Second of all, we'll work with developers that are more akin to what we're used to working with. So it'd be someone like Mitch or Mark. And then thirdly, we're not against, and that's one element of flexibility that I have with my fund that many don't, which is that we like investing in land. I don't want to go speculate on unentitled land, but we will go in and sort of cut the home builders off and buy great land and then bring them in after that. And it's a radically different negotiating session, right? So I think that if you're going to carve this, I think you've got to come at it from a couple of different directions.
Yeah, I raised my hand. I love that little feature. I would say I think it's going to be very interesting to see how the home builders play a part in the future of the sector, because I think they're going to be conflicted. They didn't want anything to do with build for rent in the early days. You know, when we first started, we had an inflection point where we had to decide, are we going to pursue home builders and GCs to build our product, or are we going to build it ourselves? And we actually were forced into building it ourselves because we couldn't find anyone to build it for the right price, the right structure, the right alignment of, product and quality and cadence and everything else that goes with it. So what happened was, when the build for rent sector blew up and just insanity and euphoria, and this is the greatest thing since the wheel and the fire, and my gosh, we have to have this. Here's a 2 cap on tomorrow's income. I know it's not even built yet, but don't worry, I'll buy it. Those days are gone. So the incentive for these home builders to sell billion-dollar portfolios of half-built, not built product that they have no idea, about the operations of, those days are gone. So the Hortons of the world and the Lennars and all these people that are in the business and have been big headlines for the space because no one cares about a small company. All they want to do is report on the big companies. They're going to be less active. The divisions don't like the product. It's not a great product. It's not built for rent. It's built for a 1-year warranty, and then it's the owner's problem. They're in locations that are usually less rental favorable long-term. There's a lot of this thoughtless selling of houses that were the headlines in the last 3 years. We're now in a part of the business where you have to have intelligence about what you're doing and why you're doing it and where you're doing it. And not to say they're not smart companies, they're very smart companies, but there's an opportunistic sale. They got into the space because I talked to every one of them. They told me I was crazy, not interested. This is 2017, 18, 19. Nobody wanted to build for us. So all of a sudden now they're all in the space. Why? Because Wall Street came knocking with big bags of money and said, I will buy it as fast as you can build it. In fact, you don't even have to build it yet. I'll buy the future inventory. Those days are gone. So I don't see these guys getting back into it in the way in which they were, which is going to limit a lot of those players' involvement in this space just naturally, because you're going to have to be far more selective because it doesn't happen fast. And it was an inventory imbalance and a money issue. People came out with so much money that you couldn't help but to sell to those guys because they wanted the product. Why not?
Yeah, what I'd add is, it all starts with the land, right? Everything has to go back to land, and whether it's, buying from home builders on inventory or developing it yourself, it all has to come from somewhere, and it all starts there. And so the future that we really see and are concentrating on in our strategy going into 2024 is, how is land treated with home builders? Because they have the biggest acquisition machine at the end of the day in terms of land sourcing opportunities. So you have to be able to educate them on how there's a value add to a bigger concept that they're already trying to do. But that takes time, takes a lot of effort. You have to jump in earlier. So you have to come up with a little bit different mousetrap of exactly how you get them to jump on board with you, especially when you know that you're not delivering things for 18, 24 months from today, and they can't come up with a price yet. And if they do, it's got a 30% margin on top of it because they don't know what their costs are going to be. So you really have to kind of dive in with them in the most creative way in the earliest point of time, and have a mousetrap once again that allows them to feel comfortable to take a discount and ride along with you for it. But you kind of have the say on how lots are sized and HOAs are put together and CC&Rs are put together, and how are amenities put in this thing, and can it be self-contained, and all these different aspects, right, that just affect what a build for rent community should do and feel like. It has to be implemented way, way early in the process. And that's, something that we've, been working on for, the last 3-4 months, and we'll continue to do so next year, is really just trying to be kind of that segue into the builders of how they treat their land, and can we be a unique piece inside of that, when land for them is probably one of the more challenging things, especially sitting on their books as public companies typically.
So we're just about out of time. I want to get to some questions from the audience because we do have quite a few. And if anybody has any more, please do feel free to put them in that Q&A area at the bottom of of your screen. We'll get to as many as we can, and any that we can't get to, we'll certainly address in future webinars and articles and podcasts and so forth. But we do have a question, again, looking forward, and I know you were all talking about seeing growth for this area in the future, but we do have a question asking, when interest rates go back down and more people will be able to afford homes, will it result in more people leaving the rental market, wanting to own a home? Do you see that? How do you see that impacting increasing inventory of BTR communities?
I'll take a quick stab. I don't think that's as a big concern of mine. Certainly, we're talking about 1 million houses a year being built and maybe 500,000 apartments on a good year. That's a break-even number of what we need. We're probably pale in comparison to those numbers the next 2 years. We'll be probably 60% of those numbers this year and maybe 50 or less next year. We're in a housing shortage, whether it's 1 million units or 5 million units. I've heard as high as 10 million units, which I think is ridiculous. But whether it's 1 million or 10 doesn't matter. It's 1 million that we're never going to get back. We're never going to solve this issue of shortage. So I think we're in this perpetual housing crisis that build for rent is going to become an increasingly important component of. And the home builders and everyone's going to try. But again, I go back to labor shortage. We're going to have a harder time building those 1.5 million units, whether the multis or single family detached going forward. So I think that as long as we're in a shortage, it doesn't really matter. It's not going to impact it. And I think we're in a perpetual shortage.
And as rates come down, prices go up, right? And so like the assets got more expensive. The land got more expensive. The infrastructure got more expensive. The labor got more expensive. Materials got more expensive. A lot of that stuck around. It didn't just evaporate. A lot of it stuck. So now you just have more expensive housing coming online. So maybe you drop 1.5 points or 2 on your interest rate, but everything else just went up 30, 40 grand. And the home builders are now used to 20 plus margins when they used to be mid-teens, low teens. And so like, that's just, it doesn't, there's no gain at the end of the day, even if those rates drop.
Even,
Yeah, and the
I mean,
gap
I'll add something really
between,
quick.
I was just going to say
Paul.
the gap between owning and renting, the last number I saw something like $800, more expensive to own. So even if rates come down and that is cut in say half, it's still a lot more expensive to own than to rent.
It's unquestionably good, in my opinion, if mortgage rates come down for the entire housing market. If you just look at, I mean, I think the purest stat is really when you compare incomes to just the simple price of ownership, and it has gotten so out of whack. It needs to forget about our business plans for a second and just say for the betterment of everybody involved, we need that to come back into balance, and it's not going to hurt any of our business plans. More people can afford to own, in my opinion.
So we didn't get a chance to get into geographic opportunity other than Paul's slide early on, but we do have some questions relating to that. So let me ask a couple of those. First of all, a broader question. What demographics do you look at to decide if an area makes sense for SFR?
Jobs, proximity to jobs. And I talk about jobs, I talk about diversity of employment base, not like one large employer necessarily, or an Amazon distribution center 40 minutes outside of town. We look for diversified employment base, transportation arterials. Can I be somewhere of importance in 20 to 30 minutes or less? And then household formation, that's big. And of course, household incomes are big.
Okay, thanks. Paul, you had talked earlier about where the most housing is being built. Where do you all see the greatest opportunities geographically? Let's talk more specifically geographically now, even city specific. I know the biggest growth has been in the Southeast and in the Midwest, but where specifically are you seeing the greatest opportunities and the greatest need for, I guess the greatest need for more housing is really my question.
All the jobs.
Yeah. I mean, there's need pretty much everywhere. But for single family rentals, there is constraint. There's a reason why, it's built in some parts of the country and not others. One of the things that has been discussed is land, right? So when you look at places where there's not a lot of SFR, say the Northeast, because there's not a lot of big blocks of vacant land in New York, Boston, Philadelphia, those places that are close enough to the jobs, right? There's land, but you got to go far out where, it's a little bit far out for commuters. So, there's a balance between, the growth in jobs, the growth in population and so on. And, where there's, the physical, ability to build large communities of single family rentals, that makes sense.
Yeah, I'd say, and some of these markets that grew so fast, right, in the Southeast also inherited a bunch of problems as well, mainly around infrastructure, right? So I think that's probably one of the biggest things that you face in most of the Southeast and parts of the Southwest is that, these cities, Charlotte, Atlanta, Nashville's, right, all of them have major capacity issues because the influx of people has been so big, it's been so dramatic so fast. So I think as you look at the major metros where probably a lot of capital wants to be at today, it's difficult to make it work, whether it's land price, land availability, utility availability, and then eventually getting through zoning and the various municipal approvals. So, we've been focusing a lot on tertiary markets. They're harder to sell to capital, but ones that are really kind of, gaining some traction, especially from a diversified employment base, because at the end of the day, operations and big, large companies are chasing the same thing that we are, which is affordability. Can I build a massive manufacturing plant in Spartanburg, South Carolina with cheaper labor than I would in Charlotte? But I still get the feed off of Charlotte because we're so close. So I think you're going to start seeing a lot of these smaller markets be big benefactors of the major markets. And those are just going to start to grow. And, the San Antonio to Austin, does that corridor just completely close up? Does the Atlanta to Charlotte completely close up? Like those are all huge arterials that you can start to focus on. And what lives in between, I think it just, at the end of the day, you have to have your data together and support together because capital is not going to be as comfortable looking at some of these more tertiary type markets.
For the
Coming out of the
Paul.
recession, we saw a very big increase in demand in rents in these like satellite metros of major markets. So like Inland Empire, people got it priced out of LA, they went to Inland Empire, things like that. But that has kind of slowed down. That's one of the things that has slowed over the last couple of years back to more normal levels. So, that's an interesting trade, but it probably the time when it peaked is sort of past. I mean, it'll continue, but not as robustly as it was a couple of years ago.
Yeah, that's what everyone's got to get used to, right? We're back to normal.
Yeah.
We went through craziness and now we're back to normal, and everyone needs to reset their expectations back to normal and what is typical in a marketplace for rent growth and expense growth and basis and costs. Like all these things need to continue to normalize, and we need to take our heads out of 2020 to late 2022 here, because that was also a moment in time, just like right now.
Maybe have to get comfortable with rent declines and flat rents, right? And the fact that you might not be absorbing, like these are real conversations that people have no idea how to look at because they saw 6 and 8% pro formas that looked great. Oh wow, it's going to be 8% growth.
Yeah. So, and Mitch, you were referring to the more tertiary markets. Do you find those municipalities in those areas to be more amenable or even eager, or is there outreach? Generally, where are you seeing the most municipal interest in attracting BTR?
Yeah, I think it's, when you see a build for rent community come in and a neighboring municipality sees it and sees the growth behind it and kind of that story building and their downtown flourishing and all the things that happen as capital comes in and people move in, that next town wants to be very similar because it can kind of see what the future looks like. So we kind of find that next tier out after where everyone is already established is important to look at and identify, but it also, once again, makes it that much more difficult to try to get a deal done because you may not have as good of supporting comps. You may not have, two communities down the street to go look to see that your rents are there. And it takes a little bit more of a story, but I think in terms of the participation that you get from municipalities helps to try to bring those type of developments to the table.
To that point, Mitch, you're right. You need good stewards of the business, because what you do in one municipality is looked upon from the other. And if you do a crappy job, which a lot of people have done and are doing, it impacts the sector as a whole.
Yeah.
Because these things can get out of hand and pretty quickly. You know, they're big, enormous assets, relatively speaking. It's not an individual homeowner. You're talking about a whole ecosystem of housing that exists under one ownership structure. It's not a 300,000. I always tell people, we're not building a $300,000 house. We're building a $65 million community.
Yeah.
They're very different operations.
Hey, one thing I would throw out just really quickly, I know we're almost out of time, but I saw a question in the chat about this. What are exit cap rates? I was saying earlier about disaggregating. I'd be curious about what you all think about this. But in my mind, and I could easily be wrong, for really, really well-located, high-quality product, I think an exit cap rate in the very near term could be in the very low fives. Would I pencil that? No. Could we get that? I think absolutely. If you look at where things are actually trading right now, on the absolute other end of the spectrum, if you're building townhomes 30 miles outside of an urban core, I think 7.5, right? So that's where I think that kind of product would trade today, 7.5. That's when I say talk about disaggregation, that's why I think you have to disaggregate, because those two, I mean, one might as well be on the moon and the other's not, right? And it doesn't mean that the moon is necessarily bad, but you just have to keep in mind that there's radically different capital and renter demand for those two profiles, right? So that would be my 2 cents. I don't know if you guys agree with that or not, but I appreciate you again inviting us to participate.
Anybody else have anything to add to that?
Yeah, all I'd say is that's kind of that's us starting to get kind of the bifurcation of product types, how you view these assets. They all have a different number to them now. They're all treated a little bit differently. So I think as we institutionalize this space more and more, we're going to start to put better definitions behind what makes these things up, and why does Mark's community trade at a 5.25 and others at a 7.5? Is sorry, 4.5, 4.5, 4.25, 4.25.
That's amazing.
There's differences, right? There's different pieces that make that up, and why they're designed certain ways, why they're run certain ways. And I think that's what we'll really start to see is these classes will start saying build for rent A and build for rent B's and C's, and they will really start getting definitions behind them, which is kind of the next chapter, I think, of this whole space, which is exciting. It's an exciting place to be in. We just got to be stewards of the product itself.
And that sounds like the place to end. Thank you for wrapping that up nicely, Mitch. Thank you all so much. We will be sending a link out when the recording's available, and we hope you enjoyed today's session, and you'll be able to join us for the next MHN Voices webinar in March, which is not on this subject, but we will keep the subject in mind and certainly revisit it soon. We do continue to cover it via our website and our digital magazine and the articles that we produce. If you're not receiving our free monthly webinar newsletter with alerts of upcoming webinars, as well as links to past recordings, and you'd like to receive that just to have it all wrapped up in one place for you, easily accessible, just let us know. We'd be happy to add you to that list. It is a free monthly newsletter. And meanwhile, once again, I would like to thank our speakers for this extremely interesting discussion, and thank you all for joining us today.
Thank you, everyone.
Thank you.
Happy holidays.
Bye-bye, everybody.